Hi, welcome back to the Dummy Investor YouTube channel. Thank you for spending time on this channel. And this is a new channel that I've just started. So before anything else, please bear with me once I, you know, get used to publishing things on YouTube. This is all new to me, and of course, I'm still learning on the fly. So my apologies in advance if something doesn't come out right. Um, Also, please do subscribe to the channel. Especially if you find something useful, valuable, something that you can incorporate in your personal investing journey. I mean, that's the ultimate aim of the channel. Um, on this edition's, Dummy Investors channel, we are, of course, right now in November 2020. And, if you see the news on some of the business news channels about where the market is positioned right now, everybody seems to be optimistic. We just had the Muhurat trading day a couple of days back, and like with most Muhurat trading days, market was obviously on its way up. And usually when there is so much of optimism, uh, hard lessons in my investing journey have told me that it's really time to keep your eyes open. And I feel we are right now at a juncture where that could be true. Of course, nobody knows what's going to happen tomorrow. Nobody can predict how long the market will continue to operate at these high levels. But really, the important decision factor for me personally, when it comes to uh, adjusting my portfolio, is offense versus defense. How much, you know, if at all, one needs to fine tune his portfolio. That's question number one. Question number two, if yes, then what do you do? Or say for example, if you have excess cash that is lying idle because it doesn't generate any returns on it, how do you deploy it? That's the question, because this is like I would say a fourth day batting pitch. And ball is clearly the pitch is crumbling. The ball is expected to turn a lot, and then so does one go out and bat aggressively, or does ta- does one take a more defensive posture? And clearly, I'm at a stage where I feel one needs to, of course, deploy capital, because you're going to get some returns out of it, but at the same time, one needs to be a lot mindful of toning down the enthusiasm and just be aware of the risk one is taking while investing capital. And um, I want to show you something which obviously I found on the internet, and let me just go to the Trendline website. There's a great source of information if you wanted to see. And what I've done is I've taken the last 5 years. I've looked at the historical Nifty uh, PE ratios, and I've mapped it to the earnings per share for these Nifty 50 companies. And of course, the headline indices, which is the Nifty 50, is not reflective of all investing styles, and I take that as an assumption. But generally, the broader market does seem a bit, or actually a lot, overheated to me right now. And if you notice, the Nifty PE has gone up considerably, and of course, that could be we are currently operating at say 34, 35 PE levels, and then you know a lot of it is because the EPS has come down. And the EPS obviously has come down since the whole COVID situation began, or the projected EPS, and that has put the price to earnings ratio considerably high. Now, what the what the the crowd is betting on is that the earnings will pick up, and this was just a temporary blip, and as a result of which some of the price movement upwards is already factored in that recovery, and that's why you see the earnings yet to catch up with the price movement. In either of the cases, assuming it's a great scenario where there's a quick turnaround of the economy, or there is on the on the downside, earnings take time to recover. We are really looking at a market which is probably on the higher side of overheating. And so, what does that mean for investors, common folk investors like us? Now, the first thing to obviously understand is that one shouldn't get swayed by the optimism. At least that's what I'm telling myself. The last major transaction I made was sometime in June. Um, I've been off equities since, and it has required a lot of patience, especially if you're a compulsive investor. I try not to be. I try to switch off from the market from time to time, but obviously we need to stay up to date on what's happening. Um, the second implication is whether if you have additional capital, then does it make sense to just hold on to the cash, waiting for some sort of a either a time correction or price correction before you start deploying it? Or do you find alternate asset classes like corporate bonds and debt funds and so on and so forth? And it's an individual choice depending on how you've so far constructed your portfolio. Now, traditionally, historically, my portfolio has been very heavy in equities, and I'm realizing that this could be a time where I could do with some amount of debt exposure in my portfolio. And so that is something that I've started executing, but I'm looking to probably think of it on a much larger scale. Um, Please do bear in mind that we are in a very uh, difficult situation because while the market seems optically overpriced and there's a lot of excess liquidity coming from foreign countries chasing the Indian equity asset class, uh, in India the interest rates are also coming down. So really, it's a catch-22 situation because the savings account will not give you returns. You can park your money in liquid funds or maybe short-term debt funds just as a temporary measure to uh, position your portfolio when, if at all, there is some meaningful um, correction, either price or time in the market. But really, it's it there there is a level of compromise involved in either cases, and one of the things that I've learned is not to time markets, and this is what Howard Marks is famous for, not to time the markets, but at least be aware what cycle of the market are we in right now. And so again, it's an individual choice on how your portfolio is constructed, what's your investment style, what's your stock picking style. Do you look at large caps? Do you look at mid caps? Or do you look at a mix of both? Also, what sectors are you involved in? And so there are a lot of obvious variables that I wouldn't know about the audience listening to this, but needless to say, I think it makes sense to just be cautious. Uh, and if at all you're investing, uh, or at least what I'm doing is at least invest in um, good quality businesses uh, with sort of reasonable fair value. And again, that's a very subjective call, but I don't find any good quality companies or businesses at screaming discount of cheap valuations. Most of them have run up in anticipation of a recovery. There are few which have been sort of lukewarm. I mean, they've run up, but they're still lukewarm. And the question then is, does it make sense to wait? And my inclination right now is to wait it out while at the same time deploying capital on corporate bonds just to have some debt allocation in the portfolio. And you know, this high P that you see on the graph could be an aberration because, like most people say, earnings could pick up. But even if earnings pick up, the price, the future returns are already built into the price, at least for most uh, large to medium equities. And so it's a tricky situation. Um, it's also important, even if you're not directly stock picking, but you're deploying money through mutual funds, please do remember that especially equity mutual funds will deploy that money, will be pressured to deploy that money in the market because they can't sit idle on cash for too long. And so you given we are moving towards a low interest rate environment, currently we are somewhere around 5.7, 5.8%, but given the interest rate environment, um, the low interest rate environments, it would be unreasonable to expect exceptional high returns, barring pockets. And those pockets could be niche sectoral plays, niche companies, small to medium cap companies which are less on liquidity or either not discovered. But again, one needs to bear in mind, and this comes from personal experience of having lost a lot of money in small caps and micro caps. One needs to bear in mind the risk and the downside of it. Obviously, you know, it's great that you are able to identify a company which is small and you get in before the big institutional investors come in. But at the same time, the company could take time to fly off. And in that period of time, it has to perform consistently given the challenging environment. Or it could be the case that you go horribly wrong in your analysis, and usually smaller companies are more volatile in the returns as well. Now, again, there's no good and bad, it's just a personal investment style, but then just please be cognizant of these things and structure your portfolio accordingly. Um, just personally speaking, for me right now, I'm obviously, like I mentioned, I haven't bought anything since June. Highly unlikely I'll buy something this year, given the way the market is operating. Um, and if at all I do buy something, it'll be in probably a sector which I'm not exposed to in the portfolio just to mix things out. But looks highly unlikely. I'll continue to at least wait and watch right now. I know it sounds very boring and not exciting because you want action all the time, but really, if you study investors who've built wealth long term, uh, they've got in at the right window. They've deployed massive capital at cheap valuations, and then they've just sat back. So, um, you just need to get a few pitches right. And I feel, at least for me, the way I am, having learned through my mistakes, I would rather wait it out a bit more instead of getting into this trap of fear of missing out. So I hope you enjoyed this. If you find something valuable in it, please do subscribe if you find something this is useful. And thank you for spending time on the channel.